I want to start out by thanking everyone, welcoming everyone, and thanking you guys for participating, for listening in and participating in our webinar. Hopefully, you will find it educational today. My name is Todd Parker. I'm alongside me is Amanda Steinle. We are both development team for Realberry Real Estate out of Denver, Colorado. We're handling two of our largest mixed-use developments set to open up starting in 2027 into 28 and 29. And we'll talk about that a little bit more. But to start out, I want to set the tone. This hour will consist of about 40 minutes of educational session. We're going to be talking about what we at Realberry see in the retail market and from our own experiences, provide some insights there. We'll follow that with a Q&A. So as we get into the presentation, I encourage you to please drop some questions into the Q&A session so that we can answer them at the end. Please do not drop them into the chat. We're going to be monitoring the Q&A, not the chat. So if you could do that, we would appreciate it. And then, so what are we going to talk about today? Let me tee up the narrative. Retail has had a complicated decade, not unlike most all other asset classes, but it really has been resilient. And we want to talk about why and where that resiliency exists. We saw a dramatic shift post-pandemic where the consumer demand really demanded a different type of retail experience. And those that listened to that demand and adapted have seen the success, while some of the older models have seen some pain along the way. So what we'll cover today, hit this real quick. We'll talk about Realberry and our long history in the sector and why we have been following these trends and see it as a strong market. We'll hop into the topic and look at what has changed in retail. And we'll talk about why grocery anchored centers in particular have a structural edge in the retail environment. And then we'll go through how we evaluate and underwrite these opportunities and end with a few examples, as I mentioned earlier. A couple of housekeeping items. While we do have some upcoming investments and we'll talk about some of our projects, we want to stress that we are here to educate. This is not a pitch. It is, if something resonates, we're happy to connect with you afterwards and can provide more information. So please note the disclaimer at the bottom of this, so the small print at the bottom. What we are doing today is solely for educational purposes. And as I mentioned, it is not an investment or other professional advice, and it is not an offer to sell securities. So with that, a little bit more of an introduction. As I mentioned, my name is Todd Parker. I am one of the VP of development for our commercial and mixed use team at Realberry. My role is to identify commercial opportunities in the market, acquire, develop, stabilize those assets. Specifically, I'm working on a large master plan community, a mixed use project called Avenue South in Loveland, Colorado. We'll highlight that project a little bit more later on, but I also want to introduce my cohort, Amanda Steinle.
Hi, as mentioned, I'm Amanda Steinle. I am the VP of Commercial and Mixed Use Development at Realberry. Similar role to Todd, we lead projects from initial concept through to completion and stabilization, help evaluate new opportunities. I have a design and entitlements background, and so I tend to focus on that area the most. So we oversee the entitlement process, lead a team of consultants, collaborate with our partners to solidify retail leasing, and then we assist in sourcing capital and financing for our projects. Before we get into the market, let's spend a few minutes on who we are as Realberry and why we're positioned to talk about this topic. We were previously known as McWhinney, named after the original co-founders, and we recently rebranded to be Realberry. In 1986, the McWhinney brothers, Chad and Troy, they started a strawberry stand in California that scaled to dozens of strawberry stands throughout the area and ultimately led to 400 acres of purchasing 400 acres in northern Colorado that then transitioned the company into a real estate company under their family name McWhinney. In 2000, the brothers partnered with the city of Loveland to develop 3,000 acres into a master plan community called Centerra. And since then, the company's expanded into multiple states throughout the Mountain West region and the Texas Triangle, developing and acquiring multiple types of assets. In the 2010s, we helped develop a few landmark projects, namely the Union Station 2014 in Denver, and then also the Dairy Block in 2018. In 2020, The portfolio growth, we broadened our asset classes, the geography, development, and acquisitions. We'll talk a little bit more about that. And then this year was very exciting. At the beginning of the year, we rebranded to be Realberry. And berry stems from the origin of the story strawberry, and real is for the purpose of the partnership that defines our work. The rebrand honors where we've been as a company and signals a commitment to delivering long-term value and commitment through real estate. This change also represents a new chapter, and it allows us to expand our investment offerings to accredited investors. Realberry has 35 years of experience. We've survived many, many different economic ups and downs. We've operated through the savings and loan crisis, the dot-com bust, global financial crisis, COVID, and we're still here and we're still growing, and something that we can attribute to our long-term focus. We've grown to 3.6 billion assets under management, 13 million square feet of diversified real estate, 1 billion of equity deployed, and 1.6 billion in total realized proceeds.
So with that, we are an end-to-end real estate solution for our investors. At Realberry, our platform is integrated, it's sponsor direct model. So this is key to our success, whether it's a ground-up development where we manage the entitlement process, construction of the asset, and then lease up to stabilization, or to an acquisition where we are identifying investments that range from value add, core plus, and opportunistic investments in target markets. We asset manage our properties, so we have a hands-on operational oversight to protect and grow that value. And our investment management, our focus throughout all these services, structuring and managing the capital on behalf of our investors. This model assures that our investors benefit from alignment at every stage, and that is truly at the heart of what we do.
In addition to our experience with a few different execution strategies, our portfolio includes a broad range of projects from multifamily, hospitality, commercial, industrial, and master plan communities. We have projects in several states, as I mentioned, the Mountain West region, as well as the Texas Triangle, and we are opportunistic. We're exploring opportunities in new markets every day, and we're even looking at possibilities internationally.
We start with our philosophy, our core investment values, and not marketing strategy. We don't just build and acquire buildings, we create environments, communities where people want to live, work, play, spend time. Activation breeds investment success for us. So this forces us to have a long-term perspective. Our investment horizon is measured in decades, not quarters. We can weather the ups and downs of the market, creating long-term value for our investors and our communities with this approach. And it instills a sense of quality in the asset while managing our fiduciary duty to our investors while keeping our eye on the opportunistic exits as well. Investing alongside our investors means that we have skin in the game. It shows assurance alignment. And we take a diverse portfolio approach, diversifying across asset classes. As Amanda had talked about, hospitality, retail, industrial, office, multifamily, and residential are all part of our platform. Realberry has flexible execution strategies and geographies, which reduces concentration risk and creates sector insights.
So we know that retail's had a bad reputation over the last many years, and it's almost a bad word in the industry, but we felt like the retail deserved a deeper dive, and hence the point of the webinar. So let's look at it. So we have a couple different questions. We thought we would gauge the audience and just find out everybody's appetite for investment a few years ago and also currently. So the first question is, how did you view retail investments 5 years ago? Did it feel too risky? Were you cautious about it? Or would you have been all in if you were the one investing? I know at that time, if you think about it back then, we were just coming out of the pandemic. There was a different way that people were operating and living their lives. The industry was hit really hard, especially commercial development. So I'm just curious how you all felt. Can everyone see the results?
I can see that now.
Pretty even, it looks like almost. That's interesting. We get it. It was risky for a lot of people. Land values were all over the place. Construction costs were increasing. Interest rates were hurting everything. So, and it just really a lot of deals kind of pencils were down because they couldn't make them pencil anymore. The folks that were all in, I understand that too. You could see that there's light at the end of the tunnel, and maybe you wanted to get in at the ground level to be in on it when there's things did turn around. So you could see the spectrum.
So then we'll have a little fun and see what current views look like, if they've gotten better or worse. So we want to know, how do you currently view, the retail investments? So pop up that quiz and take a few seconds here as well. Okay. So that makes sense to me. Still feels risky, fell, quite a bit from where we were 5 years ago, and that is completely understandable. Warming up to it, and I'm all in. It's maybe a mixed bag there. I get it. Sure. You see the opportunity and just maybe dipping your toes in on the warming up to it. We'll talk about, a focus on that in trepidation. And then if you're all in, great. Been watching the trends, you've been seeing the opportunities, but it is about the right asset classes. And we'll talk about that some more as well. Get to the next slide.
The all-in results for, recent investment, it sort of supports the point of this whole topic. Well, it's the same thing that we're seeing in the market, is that folks are now interested in retail. And so the results there are kind of in line with what we're noticing. So one of the reasons we think retail is in a strong position right now is just because vacancy is tightening. National retail vacancy is stable at about 4.4% at the first quarter of this year, and up just 10 basis points from the last quarter of 25. Just to give a little bit of context, vacancy was at about 4.5% pre-pandemic, increased to 5% during COVID, when a lot of stores were closing, and then steadily reduced their vacancy to 4.1% in 2024. And today it's about 4.4%. So really all in over the last 5-6 years, the vacancies maintained the same, come down a little bit, and we realize that the market is structurally tight. Leasing activity has risen. First quarter of this year, there was a negative 4.3 million square feet of net absorption. But in the same quarter, 4.5 million square feet of new leasing was signed. So what that tells us is that spaces are being backfilled, stores are being retrofitted for different tenants and uses, and that the story is not about contraction, it's about turnover. So with little to no new construction happening, that's what we're just noticing, and that's what a lot of the reports are saying. So new retail construction is expected to fall 37% in 2026, which just supports increased rent for the spaces that are existing. Most new development is build to suit or small format, and that the scarcity of the space available is what's keeping the vacancy low. And then capital's reengaging, sort of supporting the poll results. So even retail formats that had faced significant headwinds, they're attracting capital again. And one of our partners recently closed on a mall in California. We can't get into the specifics, but that it's a very large transaction, just signals that investors are finding value in retail again. And then the headlines on the right-hand side, the first three are from the last couple of months that just show you that there's a shift in the market and investment into retail. But not all capital is performing equally. So let's just look at how retail is not all the same.
Yeah, exactly. So retail is back, but it is not all the same. It is evolving. And to say retail is back is maybe too simple. Retail is dead is overstated, definitely was overstated, hindsight being what it is. But the recovery is real. The success stories are now evenly distributed. What we are actually seeing is an evolution. Experiential formats that align with how people live are the assets that are thriving. Formats that are dependent upon destination traffic, discretionary goods are under pressure. So outcomes do vary by format. The big structural shift is from selling goods as a commodity to selling services as and experiences. Those assets that combine the daily needs with the daily wants do well. Grocery anchored centers are a big part of that equation, and we've been all in on that for sure. Over the past decade, grocery square footage more than doubled, and F&B grew nationwide alongside these hubs. The retailers winning today are the ones that are part of that mixed use environment. And service tenants are a core or force in that new leasing as well. As of Q1 of this year, service-oriented tenants are outpacing traditional goods retailers in new volume, at least. We are seeing fitness studios, medical services, salons, food and beverage, and daily needs services are driving the number of early leases that are signed. The neighborhood formats are rising, maybe even say re-rising. They're just on a larger format now. Consumers like that neighborhood center with a neighborhood feel. The neighborhood center sales volume rose almost 25% in the last quarter of 2025, outpacing every other major retail subtype. So daily use retail is important, as is curating a strong mix of complementary co-tenancies. JP Morgan's 2026 CRA outlook, it actually singled out grocery anchored and neighborhood shopping centers as the formats delivering solid momentum entering this year, specifically because they are built around the daily utility rather than discretionary spending. So the older retail formats, the malls, the strips, the power centers, maybe to a lesser degree, that are under pressure, share a common thread. They generally depend on the consumers choosing to make a trip rather than needing to make a trip. So when that discretionary motivation softens, foot traffic follows, obviously, or doesn't follow. So location, daily utility, service orientation, and targeted tenancy curation are what separate the performers from those that lag behind.
Here are a few reasons why we feel like grocery anchored centers stand out, and a lot of the statistics support that. Grocery expansion. Grocery stores themselves are not struggling, they're expanding aggressively. The fastest growing grocer in the US. In 2025, they opened 180 stores, and in 2028, by 2028, they're planning to open 184. Trader Joe's posted a 10.4% same store growth year over year, and Whole Foods has grown 9.8%. These are not defensive actions, they're taking a share and opening locations. If service and convenience are winning, grocery anchored centers are a great expansion of both. They combine a high frequency necessity with surrounding ecosystems of service tenants that help drive new leasing activity and foot traffic.
So that reoccurring visit, those drivers, the visit frequency is unmatched in experiential retail. A grocery trip is not discretionary. It happens weekly, sometimes multiple times a week, regardless of economic conditions or consumer sentiment. No other retail format generates that kind of built-in cadence without a heavy marketing spend.
E-commerce has not, despite what might seem logical, e-commerce has actually strengthened physical grocery stores, not weakened it. They become a fulfillment and a pickup center for online sales. And JLL frames it clearly. Stores are becoming an e-commerce fulfillment engine. It makes real estate more valuable, not less, and it insulates grocery anchored centers from the substitution risk that has hurt heavy goods retail.
The performance gap versus other retail formats is measurable. As of early 2026, grocery anchor vacancy sits at just 4%. And we saw that, over on the left there, compared to 6.3% for non-grocery anchored centers. It's a 230, basis point advantage. Grocery anchored centers also command triple net rent premiums, 4.4% over comparable non-anchored product. These are not marginal differences. And that performance holds up through stress. It weathers the storm better than most. During COVID, while net absorption went negative for 4 consecutive quarters and new deliveries fell 68%, grocery anchored rents still grew by 1.5%. During the Great Recession, as another example, general retail availability surged. Grocery anchored availability barely moved. It was sticky. Needs-based demand is not a marketing term. It is a performance characteristic with a long track record.
Co-tenancy benefits as we discussed previously, the anchor builds an environment that compounds its traffic. So service providers were experiencing that fitness studios and urgent care clinics and salons and nail salons and those types of things are clustering around grocery anchored centers just because it generates additional foot traffic and it justifies their location and the rents that they commit to. In our experience, as we've discussed, many tenants contractually require co-tenancy. They have other co-tenants that they're requiring be in place in order for them to commit. And the tenants that drive, they just drive each other. And that flywheel effect is what makes leasing grocery anchored centers structurally different from a collection of individual tenants. And capital,
sorry,
really quickly, capital has also recognized this. Transaction volume in grocery anchored retail surged 42% in 2025 to nearly 11 billion. Institutional investors increased their share of acquisitions to 27%, which is the highest in over a decade. And cap rates have compressed about 40 basis points from their 2023 peak, averaging 6.7% nationally at the year end of 2025.
So, it's good to note that not all grocery anchors are equal, though. The nuance is central to our underwriting and how we approach our assets. We believe there's a clear market split, value-focused grocers that are winning the inflation-sensitive shopper versus the fresh format operators. I shouldn't say versus. It's really just finding out what's right for a certain location. But those fresh format operators are winning that wellness-focused consumers. Both ends are growing and both have their place in the market, like I say. The question we ask is which anchor fits the specific market the best, and whether it is positioned to grow its customer base there over time.
The role of mixed use in placemaking, Realberry has built a track record on placemaking and the communities that they develop. And so we feel like placemaking is really something that we're passionate about and have expanded that into some of the retail developments that we're currently working on, and how we see that also in other communities and other retail developments around the country is that retail is not 100% shifting, but the mall development is not necessarily what everybody is drawn to anymore, and that it's going more towards this community node. And grocery anchored centers that integrate into the broader mix, they outperform those that do not have that. And retail that's embedded in a residential corridor, like a neighborhood center, is performing well and is becoming a strong alternative to larger malls. And then part of the broader mixed use live work environments, foot traffic supports this, that mixed use developments generate 20 to 30% higher foot traffic than traditional retail locations. And people stay 30 to 40% longer. And then the annual retail sales growth in a mixed use environment averages 5 to 10% more versus the 2 to 5% in the standalone retail. So that just shows you that these mixed use environments really are a good alternative and good option to the mall type of developments. Placemaking is a long-term value creation strategy, well-designed, experience-driven, something that offers not just a retail experience, but maybe has something for kids that's in the same place that, you can shop and stay there all day, potentially. Residential density that we've seen follows the rooftops. Retail often will follow rooftops. And so if retail is embedded within a residential community or in the growth path of residential, office and medical development generates daytime traffic. So office workers and medical workers that are in the community help support the retail that they are within, if close by. And the public spaces, gathering areas, green spaces, and events, they extend the time that folks stay within the retail mixed use development, and then they convert what would otherwise just be a transactional experience into a destination. And Realberry has built placemaking into its DNA. We built places with purpose, and that's been the foundation of the company, and places that offer a well-rounded experience for individuals and families. And an example is our master plan community in Centera and Loveland. It's a living example of how we try to develop projects that meet these criteria.
So we've talked about how this sector is doing and how well it's doing, but it is all development, all real estate is local, right? So how do we evaluate our opportunities? Every opportunity starts with the where, as we all know, location, the market fundamentals are the best starting points. You have to know what market the location services and what the need there is. We look at the growth trends, prioritizing markets with population and migration, job growth, income growth, residential pipeline, or demand. Now, the Front Range of Colorado, where Amanda and I have two of our largest projects, exemplifies this. The projects we will talk about, they reside in areas that have a consistent track record of that in-migration, the rising incomes and the constrained suburban supply too. The socioeconomics are important. So household incomes drive spending power. We see that right now. What is shoring up spending as inflation continues to be tricky are the higher income earners. So we favor trade areas with incomes that support diversity, mixing in the fitness studios, the specialty food concepts, the personal services that help a center work well together. And then, of course, the demographics. We look at the population size, the density within a defined trade area. A grocery anchored center needs sufficient rooftops, as Amanda noted, just to justify their expansions. Bottom line is that we are not looking for the cheapest real estate. We're looking for the right real estate in the path of growth, in markets that will be stronger and more affluent 5 to 10 years from now than what they are today.
So there are multiple considerations when looking at a new retail development. Some of the core underwriting considerations that we look at when we're evaluating new opportunities and or developing our existing projects is that anchor quality, tenant mix, location, and supply constraints. These are all big factors. And anchor quality, we have acknowledged that not all grocery anchors are equal. The JLL 2026 grocery tracker makes this explicit. The old assumption that any grocery anchor delivers strong performance is outdated. So we evaluate brand positioning, sales productivity, customer loyalty, and lease term commitment. And a grocer that's posting 10% annual visit growth is fundamentally different than an anchor that has flat growth. Tenant mix, this is something that Todd and I are in the thick of at the moment for our projects. The mix that it's important that you find the appropriate mix that serves the community and serves, to Todd's point, the socioeconomics that are there, that there's an appropriate mix. And it doesn't just fill the square footage, but we think carefully about the combination of soft goods, hard goods, and the services that are there. We create a thoughtful, curated merchandising mix that fits the market, fills the gaps, and aligns with the socioeconomics. Two perfect examples, which we will discuss a little bit more, as the respective commercial mixed-use projects that we're working on in Colorado. The other thing that matters with tenant mix is just where they are placed on the plan. So we try to have cross-traffic or services that are clustered together, or that uses that may be synergistic with one another that might have cross-traffic. So that's another thought. And then just events and activations, community programming. Those are retention tools, and that, like I had mentioned earlier, it's about placemaking and creating an environment that people want to come visit and stay, not just do a transaction and leave. Location, visibility, access, proximity. I mean, the number one rule in real estate is location, location, location. And so that's just a key factor. Is it easy to access? Is it visible? Is it proximate to residential? And so that's a key factor. And markets evolve. We underwrite for long-term adaptability and sites that can accommodate changes, densification as conditions shift. And then supply constraints. As I mentioned earlier, new retail development is down and is expected to fall 37% this year, which just supports additional rent growth and lower occupancy. Sorry, higher occupancy, lower vacancy.
So understanding the downside, of course, we believe being transparent about risk. No investment is without it. We will always sensitize for the risk, always understand that exit. The tenant rollover, leases expired, and the anchor renewals are negotiated. They're not guaranteed. We stress test assumptions around releasing timelines, costs, rental rate adjustments. According to some surveys, Q1 2026 showed a negative 4+ million square foot of net absorption nationally as the market absorbs store closures. a reminder that even a healthy market experiences rollovers. So there is pain in the retail world right now, and we have to be aware of it and not lose track of that. There's been a consumer shift that we keep in touch with these trends. The bifurcation in the grocery industry into that value versus premium fresh format that I talked about means that anchor selection is increasingly a performance variable. It's not a given. A grocer losing market share to better positioned competitors is a real risk, and we monitor that. And of course, the macro environment, planning for the uncontrollable. Interest rates, lending conditions, capital placement, volatility indices, or consumer confidence all affect development, feasibility, operational performance. There is a trade policy uncertainty. The tariffs remain a wild card, political complex. I could continue on with the list of horribles when you're talking about at the macro level. But the takeaway here is adaptability and remain aware of those things and be nimble. That brings us to our risk management approach, where we instill the conservative underwriting, selection of diverse, durable, and expanding anchors, and operational control through our integrated platform. And I think that's where we're saying the grocery-centered, the grocery-anchored mixed-use centers have that ability to weather the storm. So how does this, play out in practice? We want to put our money where our mouth is. So I want to talk about a couple of projects. Amanda and I were highlighting a couple that we're working on currently that are good representations of this philosophy and the approach, as well as the product type that we're putting in the market. This first one is Avenue South. It's 140 acres, mixed-use lifestyle center in a growing secondary market. It's located in Loveland, Colorado. In what has consistently been one of the highest population and income growth areas in the state. It's anchored by a fresh format, organic grocer with a curated tenant mix that complements each other, mixing in the non-discretionary uses with the discretionary daily drivers. It is not just about the retail, though. To help drive the activation, there's 170,000 square foot of office space, which is already 75% leased, more than 400 for rent apartments, more than 450 for sale homes. And this is just phase one of the project. Phase two is planned to roughly increase those numbers by about 50%. The development is well suited for long-term positioning, incorporating the mix of different uses, focusing on the experiential live, work, play, that neighborhood center that we talked about, that consumers are demanding, really. The development is anchored by a central green space that we call the front porch, which, as its name implies, invites you to grab a lemonade, sit in a swing, and talk to your neighbors as you wait for dinner reservations, in between shopping excursions, or as you watch a performance on our amphitheater there in the central green. So this is a project that we have broken ground on and putting in the infrastructure right now. We anticipate the offering for the vertical development to go live in the next 60 days. And like I said before, please, if you're interested, reach out to us.
Very similar to Todd's project in Loveland, Colorado, I'm working on a project. It's called Center Street. It's a 63-acre mixed-use development with a Whole Foods grocery anchor. It's located in Broomfield, Colorado, and it's 63 acres within the 1,100-acre baseline master plan community. And our retail is total of 189 feet, which is made up of about 60,000 square feet of restaurant space and 132,000 square feet of retail. And then we have a office component. Our phase one office is about 60,000 square feet, with the phase two projected about 100,000 additional to that. There are multi-phases of the residential. Our first phase multifamily project is about 350 units, and we hope to break ground on that this fall. It's located just off of I-25 and Baseline Road, which is really very close to Denver and DIA, or Denver's airport, and also to get to Boulder. The economics in this area are very strong, and we know that the residential that's been developed within Baseline and also the surrounding region is going to support this retail development, as we discussed, and also kind of aligned with a lot of the strategies that we've talked about today is just some of our merchandising mix. We've really tried to cater the merchandising plan to complement the retail that's in the area today, but also just that's going to meet the needs of the community that we're building it in.
Okay, so want to thank you for sticking with us for the better part of 40 minutes here, and let's kind of start to wrap it up here. What are the key takeaways from today? Retail is evolving. The sector has undergone fundamental restructuring over the past few years. The survivors are leaner, more experiential, more habitual, more needs based. The service tenants are playing a pivotal role in that new leasing activity as well. And not all formats are equal. Grocery anchored centers carry a vacancy advantage over non-anchored retail. Rents are at a premium. Investment volume is higher, and general institutional interest level all indicate that this is a structural move. It is not temporary. Of the retail asset classes, that grocery anchored retail stands out. Historically, this has been the case, and it continues today. It combines recurring demand, e-commerce resistance, neighborhood integration, traffic drivers, and co-tenancy dynamics that create durable, needs-based cash flows. With our 35 years of experience as an integrated platform and a placemaking philosophy that creates centers people actually want to use and not just shop at, we feel Realberry is well positioned to capitalize on these opportunities. So with that, we're going to jump into the Q&A section. And I think, Amanda, hopefully you were able to pull a question or two out.
Yes, I can start. So one of the questions that's come in is, what are the main risks with grocery anchored centers, and how do you plan for things like changing over time, like consumer habits or tenant needs? We do underwrite with that risk in mind, and grocery anchored centers does not automatically mean that it's low risk. We have to look at the quality of the anchor, the lease term, the demographics, and obviously the long-term adaptability. A fitness concept today, for example, they do have a life cycle that tends to turn, and so we might have to think, okay, how does that building become? What does that building become if the fitness user goes away in a few years? And how can we adapt that building for a different type of use? We've also explored entertainment uses like a movie theater. That's another one that is something that we put a lot of thought into, because those buildings are harder for reuse. So we try to create centers that can evolve with the community, not just perform based on one tenant at one moment in time. And so just creating an architecture that's flexible, and by that I mean designing the buildings to where the demising walls can change if you have a larger tenant versus 2,500 square foot tenant. Someone might want 5,000 square foot. So just creating flexibility within the buildings that we develop today. Todd, did you have?
Yeah, pull one out of the Q&A here. Read here. Where are you underwriting construction cost per square foot? Maybe more to that, Amanda, I'll let you kind of maybe pull apart the next part of that. But to address the first one, that's tough because we're talking about a mixed use product. It's got the different elements from the residential to the retail to the office. So you can't just throw out $200 a square foot on your retail or 190,000 on your residential, your for rent product, because it doesn't quite fit the equation. We have residential over the top of retail, which skews how the numbers work. And it also varies obviously by location. Where we're working in Colorado on our couple of projects, a couple of those numbers I threw out are roughly that ballpark of what we're seeing. But we take that down to Texas and that changes. We jump over to Utah and then it changes again. So it's really about knowing the market, knowing where your product, who your product is servicing, and what the demand is there. It's an interesting time right now. We are just finalizing our construction on the Loveland project, our construction costs on the Loveland project. And in 30 years of doing this, and I hate to say that, but 30 years of doing this, this is an interesting time to be out in the market pricing. We saw a very stagnant construction costs for the better part of this last year. And just now we're starting to see some increases again. So we're keeping our finger on that pulse, making sure that we're doing our fiduciary duty to manage that risk as well. And
the second part of that question was, was about how we can get rents that support new construction. And I would say that Realberry has had a lot of success in having public-private partnerships with the local jurisdictions, and they have P3s is what we call them, in different formats of the development agreement that allows us to have a tax increment financing district, which then allows that money to be used on some of the horizontal infrastructure. And so it is very hard to make realtor projects pencil today without some type of public interest and public investment in that. And so the cities that we are working in, those development agreements have really helped us achieve those. And so it's without that public investment and to help with parking lots and water and sewer and streets, the things that will ultimately be a public benefit, it would be really tough to make these projects work. So that, along with our grocery anchor, the grocery anchor generates a ton of interest from other tenants that may not otherwise come here. So we do feel like both of those things together help us generate leasing velocity that allows these projects to work.
There's another question here about returns. Is there a development yield that you are targeting or have achieved historically? So I will say that, that obviously that changes with market conditions as well. And what we've realized this last year is that the pressure on those returns has increased. There's been a lot of capital on the sidelines, sitting on the sidelines, not unlike our poll that we took earlier. 5 years ago, people were hesitant, didn't want to deploy a lot of capital into the market, and understandably so. So there was pressure to really have a home run when you come to what your product returns look like. That has softened a little bit. Returns are still nice and they're still high. We're able to really meet our investor expectations. So that has been really good from what we're been seeing as well. Historic part of it was really where it gets interesting and how it really trends with the sentiment of the market. So, I think we might have one more.
Yep, there's a question about buying online, pickup in store models impacting physical real estate. So I did mention just the e-commerce portion of it. Although it sounds illogical, e-commerce is actually not impacting physical stores as much as what someone might think. At least that's not what we're seeing. They're becoming a fulfillment center. And so people build stores like Whole Foods, for example, is now an Amazon return facility. And, you can, if I buy something online and don't like it, I can go to a store and return it. So there is still a need for physical stores. And I do feel like that's, helping in new store development.
I think that might be it for questions. I'm not seeing any others. So I'll wrap it up here. Want to provide a little information. So Amanda, I'll let you take it.
All righty. Well, thank you all for hanging out with us for 45 minutes to talk about retail development. We appreciate your time and your engagement, and this reporting will be shared. Realberry will be sharing, deal details that are the offerings that'll be coming to the market, and we encourage you to sign up for a free account on realberry.com and to find out a little bit more about those opportunities. You can check out the link to join the platform, and it's not a sales funnel. And then for accredited investors, if you have any interest in investing in our projects, feel free to reach out to our investor relations team. Here's our contact information. If you'd like to find out any more about the projects that we're talking about or Realberry in general, feel free to reach out to Todd or I directly. And once again, here are a lot of disclaimers. Todd and I are not here to provide investment advice. We were here to just provide educational content and just kind of anecdotally what we've been seeing in the market. This is not for investment or professional advice. It's just to provide intel into what we're seeing and how we're operating today. Yeah, and we appreciate all of your attendance, and
thank you.
With you in the future.
Hopefully it was beneficial. Hopefully it was reassuring or educational. So thank you for coming.
One thing I'll say is any questions that have come in kind of later, we can provide responses to those in the recording separately. Thank you.